Long-term liabilities. Full script. Hook. Did you know that some of the world's largest companies carry hundreds of billions of dollars in debt, and their stock prices keep climbing anyway? Apple, Amazon, Toyota. They all owe staggering amounts of money that won't be paid back for decades. So how does that work? And more importantly, should you be worried about it, or is long-term debt actually a smart financial tool? Stick around, because by the end of this video you're going to understand exactly what long-term liabilities are, how bonds work, how companies account for them on their books, and why this stuff matters whether you're studying accounting or just trying to understand how businesses really operate. Let's get into it. Section 1. What are long-term liabilities? First things first, a liability is simply something you owe. If you borrowed $20 from a friend, that's a liability. In accounting, liabilities are split into two categories: current liabilities, which are due within 1 year, and long-term liabilities, which are obligations that extend beyond 1 year. Long-term liabilities show up on the balance sheet under their own section, separate from short-term obligations. Common examples include bonds payable, long-term notes payable, lease obligations, and pension liabilities. These are the big, serious commitments a company makes, usually to fund major projects, expand operations, or purchase expensive assets. Think about buying a house. You don't pay the full price up front. You take out a 30-year mortgage. That mortgage is a long-term liability. Companies do the exact same thing, just at a much larger scale. A business might borrow $500 million to build a new factory, and that debt sits on its balance sheet for the next 20 years. The key question long-term liabilities raise for investors and analysts is simple. Can this company actually manage this debt without falling apart? And the answer depends heavily on how the debt is structured. Which brings us to the most important type of long-term liability in accounting. Section 2. Bonds payable. Bonds are how large companies and governments borrow money from the public. Instead of going to one single bank and asking for $1 billion, a company splits that borrowing into thousands of smaller pieces, say $1,000 each, and sells those pieces to individual investors. Each piece is called a bond. When a company issues a bond, it promises two things. First, it will pay the bondholder a fixed interest payment at regular intervals. These are called coupon payments. Second, it will pay back the original amount borrowed, called the face value or par value, when the bond matures. Here's where it gets interesting. The interest rate printed on the bond is called the stated rate or coupon rate, but the rate the market actually demands based on current conditions is called the market rate or effective rate. If these two rates match, the bond sells at par, meaning exactly its face value, but they almost never match perfectly. If the market rate is higher than the coupon rate, investors won't pay full price for the bond. They'll only buy it at a discount, less than face value. If the market rate is lower than the coupon rate, investors will actually pay more than face value, a premium. Understanding why bonds sell at discounts or premiums is the foundation of bond accounting, and that's exactly what we need to dig into next. Section 3. Accounting for bond discounts and premiums. Okay, here's where accounting students often feel a little dizzy, but stay with me. It's actually very logical once it clicks. When a company sells a bond at a discount, it receives less cash than it will eventually have to repay. That difference between what it received and the face value it owes is recorded as a contra liability called discount on bonds payable. This account reduces the carrying value of the bonds on the balance sheet. When a company sells a bond at a premium, it receives more cash than the face value. That extra amount is recorded as premium on bonds payable, which increases the carrying value. Now here's the critical part. These discounts and premiums don't just sit there forever. They get amortized over the life of the bond. The most accurate method for doing this is called the effective interest method. Under this approach, interest expense each period is calculated by multiplying the carrying value of the bond by the market rate at issuance. The actual cash payment is calculated using the face value and the coupon rate. The difference between those two numbers is how much the discount or premium shrinks each period. What this means is that a bond sold at a discount will have a carrying value that gradually increases until it reaches face value at maturity. A bond sold at a premium will have a carrying value that gradually decreases to face value. By the end, the books are perfectly balanced. Pretty elegant, right? But there's another piece to long-term liabilities that companies deal with every single day. Section 4. Notes payable and installment loans. Not every long-term liability is a bond. Companies also borrow money through long-term notes, payable basically formal written promises to repay a lender with interest over a set period of time. These work a lot like the mortgage or car loan you might personally have. With installment loans, the borrower makes regular equal payments over the life of the loan. But here's the twist. Even though the payment amount stays constant, the breakdown of each payment changes every single time. Early payments are mostly interest, with a small chunk going toward reducing the principal. As time goes on, the interest portion shrinks and the principal portion grows. This is called an amortization schedule, and it's something accountants prepare to track exactly how much of each payment is interest expense versus repayment of the debt. For companies, this matters because interest expense is tax deductible, while principal repayment is not. Getting this split right is both a legal requirement and a financial strategy. And speaking of strategy, there's one more major category of long-term liabilities that's become increasingly important in modern accounting. Section 5. Lease liabilities and debt ratios. Companies don't always buy assets. Sometimes they lease them. Think of airlines that lease aircraft or retailers that lease store locations. For years, companies could structure leases in a way that kept the debt completely off the balance sheet. Investors hated this because it made companies look less risky than they actually were. Accounting standards changed this. Now, most long-term leases, called finance leases and operating leases, must be recognized on the balance sheet. The company records a right-of-use asset and a corresponding lease liability. This gives everyone a clearer, more honest picture of what the company actually owes. Once all long-term liabilities are on the books, analysts use ratios to evaluate them. The debt-to-equity ratio compares total liabilities to shareholders' equity. A higher number means more financial risk. The times interest earned ratio measures whether a company earns enough income to comfortably cover its interest payments. These ratios help investors, creditors, and managers understand whether a company's debt load is manageable or dangerous. Long-term liabilities, when used wisely, are a powerful tool for growth. When mismanaged, they can bring even giant companies to their knees. Outro and CTA. So let's recap quickly. Long-term liabilities are obligations due beyond 1 year, bonds, notes, and leases being the most common. Bonds can be issued at par, at a discount, or at a premium depending on market interest rates, and the difference gets amortized over time using the effective interest method. Installment loans are tracked through amortization schedules that separate interest from principal. And lease liabilities are now reported on the balance sheet, giving a more accurate view of a company's financial obligations. Debt ratios tie it all together by helping analysts evaluate financial risk. If this video helped you understand long-term liabilities in a way that actually makes sense, smash that like button. It genuinely helps this channel reach more students like you. Subscribe so you don't miss the next video, and drop your biggest question about long-term liabilities in the comments below. I read every single one. You've got this. See you in the next one.